Entry multiples and when they matter. With 2025 closing, I believe it's appropriate to do a small update on some of the companies I have covered throughout the year. I will go through some companies which I stated was either slightly overvalued or at fair value for a decent, but not incredible return. The two companies I will be focusing on first are the Norwegian IT consultancy firm BOUV as well as the internet service provider BAHN. Both of these companies have seen drawdowns since my episodes about them, which is not really surprising. I explicitly stated that they could see multiple compression in the near future and that this could be a potential buying opportunity. First up, BOUV. The episode released when the company traded at 80 NOK per share. I stated that this was an IT consultancy firm of the highest class and where the risk is lower compared to other players in the sector. If you compare the company to others in the same sector and tries to compare the PE multiples, you're severely missing the mark, in my honest opinion. Today the shares trade below 60 NOK per share, corresponding to approximately 16 times earnings and a yield of above 6%. I stated that the company was a buy at 15 times earnings due to the capital light model and expected forward growth. Recently, the company briefly did trade at 15 times earnings when the shares traded as low as 57 NOK per share. The drawdown in the stock was due to a normalization of operations in Q3, which saw unprecedented demand in 2024. The strong comparables meant an earnings decline. This spooked the market and presents an opportunity, in my opinion. In the following quarters, we will see a gradual normalization of growth. My long-term growth expectations of 10% still holds. Added to the free cash flow yield of 6%, a higher than 15% annual return is expected with my estimations. Moving on to BAHN. At the time of the initial episode, the company shares traded at a 30 times PE multiple at 61 SEK per share. I stated that I needed a 15 to 20% haircut before investing, as the multiple was simply too high compared to expected growth. Since the episode, the shares has fallen 15% to 52 SEK. Still, I haven't yet opened a position as I want the company to trade around 25 times free cash flow, corresponding to a yield of 4%. We are very much closing in on this price, but patience is a virtue. The 4% yield is not arbitrary, but because I estimate a long-term free cash flow growth rate of around 11%. Initially, the growth will come from high single-digit growth from the home market in Sweden. The rest of the growth needs to come through international expansion, mainly from Norway in the short term. Over time, I believe in lower growth from Sweden, but higher growth from the international expansion. Still, the long-term growth rate is expected to be around 11% per annum. Thus, I need a 4% yield or 25 times free cash flow in order to obtain a 15% annual return from the stock. I would understand if someone listening thinks that I'm nitpicking a lot and that I'm deemed to forego a lot of opportunities if I'm this reluctant to buy a company that I'm interested in. However, I believe it's very important to be wary of multiple compression. If BOUV falls from 20 times earnings to 15, I lose 25% of my return. If BAHN goes from 30 times earnings to 20, I lose 33% of my return. I need a lot of growth to combat such a large fall in the multiple, and therefore I must be very patient before buying. Observant listeners may find my obsession with the entry multiples strange when looking at some of my other companies, specifically GENI, MEDI, and OPTER. All of these had high initial multiples, from between 28 times to 40 times earnings. A reasonable question is why I'm comfortable owning companies with such high multiples. Keep in mind that both GENI and OPTER have seen large multiple compressions since my episodes, while MEDI has seen expansion. The important difference between the two cases are the growth phases in which the companies find themselves. BOUV and BAHN are stable, predictable, quite boring businesses, which keeps chugging along year after year. Not much of note will happen from one year to the next. Growth will linger around 10% a year for both of them. In such a case, the entry multiple severely determines your return in the stock. In the cases of GENI, MEDI, and OPTER, they have only captured a fraction of their total addressable market. It's not out of the question to see earnings growth above 30% in some quarters. In the cases of generic and OPTER, their market caps are below 1 billion Swedish kronors. Every quarterly report to the upside, or downside for that matter, might move the stock double digits. When the quarters can fluctuate this much, and the long-term growth potential is so large, it makes little sense to dwell over a 15 to 20% higher or lower initial purchase price. We saw this with MEDI, where both Q1 and Q2 surprised to the upside and lifted the stock 20% of the day. In such cases, lingering on paying 25 or 30 times earnings means that you might lose out on the long-term potential. 30 times earnings seemed high for MEDI going into 2025, but the stock has increased 80% throughout the year. On the other hand, you have a company like OPTER. They saw a surprise to the downside, and the stock has decreased 30% in 2025. Slower than expected growth has led to multiple compression. 1 year ago, when we were going into 2025, I wouldn't bet on which one of MEDI or OPTER that would outperform in the next 12 months. I own them due to their capital-light business models and my expectations for long-term growth. One stock surprises to the upside, the other disappoints. These things are deemed to happen, and the roles may well be reversed in 2026. Therefore, I won't linger on a 15 to 20% haircut in these kind of companies. The long-term earnings potential, meaning 3 to 5 years down the line, is a lot higher compared to last year's earnings. In such a case, the increase in earnings will largely determine the return in the stock and not so much the entry multiples. As a consequence, I haven't changed my position in neither MEDI nor OPTER, as my long-term growth expectations remain the same. Next quarter's growth, however, is anyone's guess. Hopefully, this makes clear my thinking about entry multiples. In some cases, they largely determine your return. In others, obsession with multiples may cloud your view over the long-term potential. Thanks for listening.